It's our cash flow series part 2, the 4 ways that real estate investors make money. 4 ways that real estate investors make money. That's today's episode. Let's dive into it. Hey everybody, welcome into the Investing in Real Estate show. I'm Clayton Morris, longtime real estate investor, and I'm on a mission this year, which is to help people buy performing assets. Stop worrying about the property. Stop caring if it's got adorable little shutters and a little flower bed out front. It's about cash flow. Are you bringing in cash flow every month? That is the secret to making money. And on today's cash flow series, we're going to be talking about the 4 ways that real estate investors make money month in and month out. Now, throughout this entire series, it's all going to come down to these 4 principles. And not every income investment property is going to look the same. So let me explain what these 4 principles are, and then we'll get into the nitty-gritty on each of the 4, okay? Number 1, cash flow. Number 2, appreciation. Number 3 is loan amortization. It's such a hard word to say. Say it with me a couple times, will you? Loan amortization. If I say it real fast, I get that Philadelphia thing going, and I say loan amortization, just kind of fly through it. Loan amortization. See how difficult that is? I'm not going to try to say it very much if I can. And number 4 is tax shelter. Number 4 is tax shelter. So again, not every income investment property is going to look the same, provide the same returns in an equal measure. For instance, you might have a property that you've had for a number of years. It's not a great cash flow machine. Maybe it doesn't really make anything in cash flow, but you see that it's an appreciating area, and so you're going to sell it and make some boku bucks on it. Okay, so the cash flow is kind of awful, but when you sell it, you're going to make some great money. You could funnel that into a 1031 exchange and then buy some cash flow. Maybe buy 10 properties that cash flow with a nice return on investment. So one property may give you some nice annual cash flow. You might have great returns, like what I try to do in all the properties I get. And then you may have a loan on the property, which is also producing income for you in another way. And you may have it as a great tax shelter. For instance, let's say, unfortunately, one of your properties got hit hard in one of the hurricanes. Guess what? Maybe you have a FEMA maybe you have some FEMA assistance on that property now, and guess what? You're not going to have to pay taxes on that property for many years to come. So you're creating a tax shelter. Taxes and cash flow are 2 enormous ways that you make money in real estate investing. It's key, right? Really few other areas create an enormous tax shelter in the way that real estate does. So keep in mind those 4 things as we move through this. So from this point on, really every calculation and concept we will discuss will all come back to these 4. I want you to really understand that that's how you make money in real estate. So when you're analyzing deals, as you're putting pen to paper and you're starting to figure out if this is for me, it all has to come back to this. So here's a perfect example, right? Let's look at a B-class property. Now, I've done a whole series of videos and audio recordings around the difference between an A, B, and C-class property. Now, you know that the bulk of every property I own is a C-class property, right? Blue-collar neighborhoods, near the hospitals, near Amazon distribution centers, near the FedEx distribution hub, whatever it is, American-based jobs, blue-collar, hardworking. It's going to have a good amount of rental properties. It's going to have some, a strong component as well of home ownership in those neighborhoods, transitional neighborhoods that are kind of moving towards a B. That's where the real money is made. It's in those C-class neighborhoods. I also own a bunch of B-class, right? B-class properties are the ones that are already moving in that direction closer to an A. They've got maybe some better schools. They've got a few more bells and whistles. But guess what? The cash flow is going to be a little bit lower. Cash flow will be a little bit lower. So again, you're going after a bit of an appreciation play when you've got that B class. So what does that mean? That means it holds 2 elements of these 4, right? It's got a little bit of appreciation. It's got some cash flow. And you're not going to get the cash flow that you get from a C class. Then you might be able to sell the property in a few years and then buy 2 C-class properties, right? So you take the appreciation from your B class, you roll it into 2 C-class, and then maybe one of those starts to move into a B class. You add some granite countertops later on as it grows and grows, and then you sell that one off and you buy 2 more. See, that's how the game is played. That's how a smart investor moves and pays attention to their portfolio on a regular basis. I hope that makes sense. So let's talk about cash flow. Do you have a checkbook laying around? If so, then you already understand the idea of cash flow. So all cash flow is, and the most important question you should be asking yourself at the end of the month is, how much cash flow came in to your LLC or to your business checking account from the properties you own, and how much went out? That's it. That's it. That's all it is. That's all it is. Cash flow. If you have spent more than is coming in, you have negative cash flow. So bottom line is you want positive cash flow coming in every month from your business, your rental properties, your investments, monthly. What does that look like? You want to hear how smart like AT&T is? Listen to this, right? AT&T charges you monthly, okay? They charge you monthly for your phone bill, right? Guess what? They then pay their investors quarterly dividends. So who's getting the short end of that stick, right? AT&T is making cash flow every month off of you because of your phone bill, and they're only paying out quarterly to these people. Guess what? That money isn't sitting in their accounts earning them money. Cash flow, month in and month out. All right, let's do a cash flow example to help you out. So on a typical property that I buy, let's say the rent is $800 a month, okay? Let's say this is a 3-bedroom, 1-bath house. Let's say the cash flow is $800 a month, so 800 times 12 months gives me $9,600 a year in cash flow from that property, from those tenants, okay? Yes, then we want to take out maintenance, you want to put that aside, you want to put out your taxes, and of course your insurance and your property management fees as well. So I like to take out 40%, which is a really conservative number. So I'm going to multiply this times 0.6. It's going to give me $5,760 in cash flow. That's a great return. So I'm getting $5,700 a year in cash flow from that one property. And the beauty of that is that it's going to do that every year. I'm going to be able to produce that kind of cash flow every year. And we'll get to the tax shelter in a moment here, because when we talk about repairs, that then offsets the income that we're receiving from this property. The tax shelter alone also makes you wealthy. The second way that real estate investors make money is on appreciation. Right now, appreciation to me is really dead as a primary way of investing. Now, we saw during the 2007-2008 collapse that people were just buying on appreciation alone, speculation, right? They weren't really even focused on cash flow. They were focused on buying it for $200,000, turning around like a month or two later and selling it for $250,000. The appreciation game. Guess what? That all dried up. But now we are seeing nice, healthy appreciation in a lot of the rental markets that we invest in. Yes, you're going to see appreciation in more of the B and A neighborhoods that are going to be in those, San Francisco, New York, Miami, in those neck of the woods. So I do not invest for appreciation. However, if like I said, I've got a strong B-class property that is going to appreciate a little bit, goes up, and with a nice little chunk of equity added to it over the years, then, and maybe I haven't added those extra bells and whistles to the property yet, because I don't like to overspend on that stuff. Maybe then I do add in the granite countertops. I add in some extra nice fixtures just to kind of give it a little bit more pizzazz. And then I might consider selling that property because of the nice appreciation that it's received over the years. Now, am I just going to sell it, take the cash, and go party? No, I'm going to sell that property in a 1031 exchange, which we can dive deep into 1031 exchanges. I've certainly done that here on the channel, so no need to spend the time on it now, but please check out those episodes that we talk about. Taking that money, rolling it into a 1031 exchange, and now I might buy 2 properties for the price of 1, right? So maybe now it appreciates to $100,000, I sell it for $100,000, and I buy 2 $50,000 properties with a higher return on investment. And then maybe one of those starts to grow. And every few years, analyzing your portfolio to see where the appreciation is. So appreciation as a main investment strategy, no, that's not what I do. Icing on the cake, absolutely. And if you've got 50 properties, 5 of them are in B plus neighborhoods that are appreciating, analyze those because it might be time to sell one or two of them off and expand your pie even bigger and purchasing more real estate. All right, number 3 on our list is loan amortization. I'm not going to say it again, at least I hope not. Well, this is simply the liquidation of the debt, and it's by the application of installment payments over time. So what does that mean? Well, that means that you remember when you purchased your property that you live in, you probably got a stack of those coupons from the bank that showed for your 30 years, this is how you're going to be paying this property back. The first 7 of those years typically were interest, right? So the bank's making all this interest off, and they front load the interest up front, and it's amortized over those many years, and it's the installment payments. So now if you're buying a large, $1 million apartment complex and you're putting down $300,000 and you're financing $700,000, well, who's going to make those mortgage payments? Well, the way in which you're building wealth is because the tenants are going to pay for you to own that property fully. That's another way that real estate investors make money. They're building equity by having tenants pay their amortization schedule down. It's brilliant, right? And many people know the term house hacking, which is simply, maybe purchasing a duplex that you live in one side of it, and the tenants on the other side are paying your full mortgage for the entire property, basically allowing you to live rent-free, mortgage-free, because the tenant next door is paying for the mortgage on the entire property and covers all of your debt service. Another great way is that you're also paying interest on this. So at the end of the year on your taxes, you're able to look at the interest deduction on your taxes for your investment property. And of course, that fluctuates with the different tax laws in different states and how much you're allowed to write off. Obviously, consult your own tax accountant on that and what you're able to do. But by having that amortization schedule on that property, then you're allowing your tenants to make you profitable, building that equity. So if you only had $300,000 in equity over the years with all of your tenants paying it, now you've got $400,000 in equity, $500,000 in equity, and you're building up your net worth. Your asset is continuing to perform while you're also getting to write off your interest deductions on your taxes. So loan amortization is the third way that we can make money in real estate investing. And the fourth way that real estate investors make money is tax shelter. In fact, I know a lot of really savvy investors that own thousands of properties that this is their primary concern, is the tax shelter. They almost don't even care about the cash flow. So think about that for a second. Tax sheltering their overall income is the most important part of real estate investing. Why? Because an income property investment can shelter some of its own income from taxation, right? And can also then shelter income from other investments. What? It's mind-blowing, I know. But think about it, right? The income coming in from that particular property can be offset by repairs, by other things that you're doing to that property. But income that you're getting from other sources can now be sheltered in real estate in the form of repairs. Other taxable income can be sheltered there because you're putting it into income producing property that the tax code likes. The tax code is written for you as a real estate investor to take all of the advantages of tax sheltering. That's how the whole code is written. So we should take advantage of it. In fact, it even became more strong during this last GOP tax bill that was passed at the turn of the year in 2017. So whatever's left over is your NOI, your net operating income, on which you would expect to pay taxes, right? What's left over after you've sheltered it, you've made some repairs, you've done extra things with it, you've written off deductions for your home business because you bought a printer, you have printer paper, and you're running an LLC, so you're running it as a business. You have all of these expenses, right? Maybe you're even driving around in your local neighborhood. You're managing the properties yourself. Gas mileage is a write-off. All of those things for your property. But whatever's left over is your NOI, your net operating income, and you would think you'd pay a lot in taxes on that, right? Well, guess what? This is why you buy until you die. Continuing to purchase real estate helps to offset your NOI. It also benefits you in other ways with the tax shelter. The first of these deductions is the mortgage interest deduction. So interest is really the cost associated with acquiring the property and then operating it. And so being able to offset that interest. If you're making large purchases and having that mortgage interest deduction there, it's also offsetting the NOI, their net operating income. So you can basically, that's why as any smart investor will tell you, Tom Wheelwright, Robert Kiyosaki will say, they pay nothing in taxes. Why do they pay nothing in taxes? Because they're a real estate investor, and because they're using the tax code, they're using the purchase of other property, they're using what the second rule here is, depreciation, to offset that NOI. And they end up paying a big goose egg. Nothing. Can you name another area in which you could do that? Another investment strategy in which you could pay nothing? Can you think of it? I can't. Even owning raw land, while sexy and nice, still does not have that cash flowing asset sitting on top of it that you get to depreciate, because you cannot depreciate raw land. It doesn't depreciate. So that is the second source of tax sheltering, is depreciation, which is now called cost recovery in the tax code. And look at the numbers on it. Yeah, the cost recovery. I love how they get all technical with this, but instead of depreciation, it's cost recovery. But usually when we as investors still talk about it, we still talk about it as depreciation. So this is what I love about it, right? Even though the value of the property is probably increasing over time, right? You're able to depreciate it in the tax code. Things that you have to fix, right? You may have to fix the roof. You may have to do other things. Guess what? Now in the tax code, you can even break it down further into what's known as a cost segregation. And you can depreciate individual items in the house themselves. That's where you need a really savvy tax accountant who does cost segregation specifically. You would actually hire a cost segregation expert to fly out to, and they don't want you to just do one property. You mostly, if you've got like 10 or 15 rental properties, or even more, that's when you would actually start to look at doing like a cost segregation, or multi-units, like 100 unit or 15 unit, those types of places, because they can go in and individualize each one of them. They're going to spend a few days in that town. You're going to pay their airfare. You're going to pay all that stuff for the accountant to go and do all of this. But it's incredibly worth it once you get to that level. But again, depreciation is an incredibly strong way of also sheltering some of this income and being able to protect your money. I don't want the government getting more of my money. I earned it. I went out there, fixed up a property, produced a great property that's going to provide for that neighborhood. I've turned this neighborhood around, and I've done that on up and down streets that I own properties. Going up and down certain streets like Dearborn and Olney, I can name these streets where we've bought properties up and down these streets and literally revitalized the whole street. That's good for the city. That's good for the tax code, right? Now other people are buying these dilapidated houses. They're paying property taxes. It's elevating the entire neighborhood. It's elevating the entire city. So the exhilarating part about depreciation is that if any part of the tax code can be described as this, it's that it's a non-cash deduction. In other words, you get a deduction without writing a check. That's amazing, right? It does not affect your cash flow. So I get a deduction without having to write a check. So again, the 4 killer ways to make money in real estate investing. And that's really how the cash flows in this entire game. It will fit into one of these 4 areas. Sometimes they will bleed over into 2 of them, right? And sometimes you might have all 4 of them, which is rare, but you might have all 4 of them tied up in one investment. Again, incredibly rare. But think about that as we build cash flow. Does my investment fit one of these models? If not, I'm going to tell you right now, it's probably not a smart investment. It's got a cash flow. If it doesn't cash flow, it better have appreciation, because you're going to sell it and buy things that do cash flow. 3, is there a loan associated with it that's helping me become wealthy? Are tenants helping me become wealthy by paying down my mortgage? And number 4, the tax shelter. There's perhaps no better investment strategy than leveraging real estate, using it as a tax shelter. I have friends and family and investing mentors who've purchased properties. The whole reason they do it is to shelter all the other income they have from their lawyer business, doctor business, whatever it happens to be. They need a tax shelter. And a tax shelter of real estate is second to nobody, to none. So that's part 2 of our cash flow series. I hope you've found this valuable, help you with your strategy as you move forward with real estate investing. Again, we're going to be diving deeper into all of these things as we progress through this series. This is just sort of the beginning to kind of set the stage, to wet the wheels, and we're going to get much deeper into cash flow and how it operates and how it can benefit you to become truly wealthy. If you haven't already subscribed, please do. Click the subscribe button. Tell your friends and family about this. Anyone in your life that you know you'd like to help build wealth and get them on the right path. We publish this show multiple times per week, all in an effort to help you get out there, take action, become a real estate investor. It's the #1 way to build wealth, my friends. We'll see you back here next time.